The US national debt is out of control, and it's growing faster than you think. Right now, the US owes more than $33 trillion, and every second, it adds another $30,000 to that total. To put it in perspective, if you tried to count to $33 trillion, it would take you over 1,000,000 years. This staggering amount isn't just a number, it's a ticking time bomb, ready to explode at any moment. Most people don't realize just how bad things are. By 2029, the US could spend more on interest payments than it spends on defense. Imagine that. Money meant to protect the country could be used just to pay off debt. And with interest rates rising, that's not just a far-off fear, it's something that could happen in the near future. In this video, we'll dive into the truth behind the debt crisis, uncover the shocking reality of who really holds America's debt, and show you how this all impacts your financial future. From inflation to global consequences, we'll explore the strategies the US is using to avoid default, at least for now. Stay tuned as we break it down, step by step. You won't want to miss it. Chapter 1. The Debt Crisis, a ticking time bomb. The US national debt is a ticking time bomb, and it's only getting worse. As of 2025, the national debt has surpassed $33 trillion, a number so large it's hard to wrap your head around. To put it in perspective, the debt is more than double the size of the US economy. Every second, the US government borrows over $30,000. That's an unsustainable pace. But the real danger isn't just the number, it's the trend. The debt is growing faster than the economy itself. For years, the US government has spent more than it collects in taxes, and the gap keeps widening. This year alone, the deficit is projected to exceed $1 trillion. The situation is so dire that the US Treasury is now spending more on interest payments than on defense. The government is essentially on a borrowing treadmill, constantly taking on more debt to pay off the old debt. And while most Americans focus on the surface, the underlying problem is the inability of the US government to reduce this burden. The US can't simply print money and expect everything to be fine. What's even scarier is that the US government is running out of options. Interest rates are rising, and servicing the debt is becoming more expensive. In fact, by 2029, the interest on the debt could consume more than 20% of the federal budget, crowding out spending on other important areas like education and healthcare. The numbers simply don't add up. This debt crisis is unlike anything the country has faced before. It's not just a financial problem, it's a political one. Congress can't agree on how to fix the problem, and the longer it takes, the worse it will get. The clock is ticking, and we're running out of time. Chapter 2. The too big to fail paradox. Why default is impossible. For now, the US government is often called too big to fail, but that doesn't mean it's out of trouble. The paradox is simple. The US can't afford to default on its debt, but at the same time, it can't repay it either. How can that be? For decades, the US has been able to borrow endlessly because the dollar is the world's reserve currency. This gives the government access to cheap credit. Countries, companies, and individuals all around the world hold US dollars, and they want US Treasury bonds because they're considered the safest investment. As a result, the US can run a deficit without the same immediate consequences that other countries might face. But here's the catch. Just because the US can borrow doesn't mean it should. While the US is too big to fail, in the sense that a default would wreak havoc on the global economy, this has led to a dangerous game of fiscal irresponsibility. The US's ability to keep borrowing doesn't make the debt sustainable. Instead, it encourages the government to spend more than it should, leading to even higher levels of debt. Historically, countries like Greece have faced default due to mounting debt, but the US has always been able to avoid that fate. Why? Because investors trust that the US will keep paying its bills. Yet, as debt increases and interest rates rise, this trust could erode. Eventually, the US will face a reckoning, and that too big to fail label might no longer hold true. Take China, for instance. As one of the largest holders of US debt, China could, in theory, sell off its treasury bonds and hurt the value of the dollar. This could lead to a financial crisis. However, doing so would also hurt China, as their reserves are tied to US debt. The US might be too big to fail, for now, but the dynamics are shifting. In the short term, the US can keep borrowing, but over time, this strategy is unsustainable. The government is backed into a corner. Default would create chaos, but continuous borrowing is putting the economy at risk. The paradox will only become more apparent as the debt continues to rise. Chapter 3. Inflation. The silent tax that erodes debt. Inflation, often overlooked in discussions about the national debt, is one of the most powerful tools the US has to reduce the real value of its debt. But this silent tax comes at a cost. While inflation erodes the value of money over time, it also makes it easier for the government to pay back its debt in real terms. In essence, inflation acts as an unspoken strategy to reduce the debt burden. Consider this. If inflation rises by just 3% per year, the value of a $1 trillion debt drops by $30 billion in 1 year. Over a decade, that's nearly $300 billion. The higher the inflation, the more the government benefits, because the debt becomes easier to manage. But of course, this comes with risks. Rising inflation means prices for everyday goods go up, which hurts consumers. A gallon of milk might cost more, and the cost of living becomes harder to bear for average Americans. But for the government, inflation acts as a kind of stealth debt reduction. The real value of the money owed becomes smaller, easing the pressure on the budget. In fact, inflation played a major role in reducing the debt after World War II. The US saw inflation rise sharply in the 1940s, and as a result, the national debt as a percentage of GDP dropped significantly. This strategy helped the US recover from a crushing war debt, but the effects of inflation aren't always predictable. Inflation also shifts the burden to savers, especially those holding cash. The value of their savings declines, which means they lose purchasing power. This is a hidden cost that many don't realize until it's too late. But from the government's perspective, it's a way to reduce the real value of the debt without making drastic cuts to spending. For investors, this inflationary environment presents both risks and opportunities. Bonds, for example, are sensitive to inflation. As inflation rises, bond prices tend to fall, and yields increase. In this kind of environment, investors may want to consider inflation-protected securities or even assets like real estate, which can appreciate in value during inflationary periods. While inflation may help the government manage its debt, it's not a long-term solution. Over time, inflation can lead to a loss of confidence in the currency, which could trigger a larger financial crisis. The key is finding the balance between manageable inflation and sustainable debt. Without that balance, the consequences could be dire. Before we continue, if you're finding this information helpful, make sure to hit that subscribe button. Stay updated on the latest insights that can help you protect your investments. Chapter 4. The Global Reckoning. Who really holds America's debt? When you think about US debt, it's easy to imagine that the government owes money to American taxpayers. However, the truth is far more complex. The US is heavily indebted to foreign nations, and this has a significant impact on its economy. Currently, around 30% of the national debt is owned by foreign countries. China and Japan are the largest foreign creditors, holding trillions of dollars in US Treasury bonds. China, for example, holds about $1.1 trillion in US debt. This makes them one of the largest creditors of the US government. The reason China continues to buy US debt is simple. They need to keep their currency, the yuan, relatively weaker to maintain their export-driven economy. By purchasing US debt, China helps keep the value of the dollar high and the yuan low, making Chinese goods cheaper for foreign buyers. However, this creates a dangerous situation. If China were to suddenly decide to sell off its US Treasury bonds, it could cause a sharp drop in the value of the dollar, leading to massive economic consequences. It's a delicate balancing act, but as much as China depends on the US also relies heavily on Chinese investment. So far, the strategy has worked, but the risks are growing. Japan is in a similar situation. They hold over $1 trillion in US debt, and their motivations are similar to China's. For Japan, holding US debt keeps their currency weaker, which benefits their export market. But the more the US borrows, the more leverage foreign nations like China and Japan have over the US economy. It's not just China and Japan, though. Countries like the UK, Brazil, and even oil-rich nations in the Middle East hold significant portions of US debt. The question is, how long will they keep buying? If any of these countries were to pull back, it could lead to a global debt crisis. The US is caught in a web of interdependence with these foreign creditors. This reliance on foreign debt also complicates the US's ability to manage its finances. As global tensions rise, particularly between the US and China, there's a growing possibility that these nations could use their holdings as leverage. For now, it seems unlikely that foreign creditors would move to dump US debt en masse, but the risk of geopolitical shifts affecting the debt market is very real. So, while the US government may be too big to fail, it's not immune from the consequences of foreign debt. The question is, what happens when foreign governments start questioning the US's ability to repay? It's a ticking time bomb, and the longer the US relies on foreign creditors, the more vulnerable it becomes to sudden shifts in global finance. Chapter 5. Value Investing 101. What does all this mean for your portfolio? As a value investor, the US national debt crisis presents both challenges and opportunities. With the national debt growing at an alarming rate, it's natural to wonder how this will impact your investments. The good news is that value investing can be a powerful strategy in navigating these uncertain times. Value investing is all about buying undervalued assets that have the potential to increase in value over time. In a world where the US national debt continues to rise, inflation is on the horizon, and the economy feels unstable, finding undervalued assets is more important than ever. But how do you identify them? One of the key strategies for value investing in this environment is focusing on companies that have strong balance sheets and minimal debt. These are the companies that will survive and thrive even if the economy faces a downturn. Look for companies with consistent cash flow, strong earnings, and a proven track record of managing debt effectively. In addition, consider investing in sectors that tend to perform well during inflationary periods. Real estate, for example, is often seen as a good hedge against inflation. As the value of money decreases, the price of physical assets like real estate tends to rise. This is especially true in areas with strong demand and limited supply. Another area to explore is precious metals, such as gold. Gold has long been considered a safe haven in times of economic uncertainty. As inflation erodes the value of the dollar, the price of gold often increases. By including gold or other precious metals in your portfolio, you can protect your wealth from the effects of rising inflation. Stocks in defensive sectors, such as utilities, healthcare, and consumer staples, can also be attractive in times of economic uncertainty. These companies provide essential services and products, so they tend to perform well even during recessions. They may not deliver the high returns of tech stocks, but they can provide stability when other investments are struggling. As inflation rises and the dollar weakens, the price of commodities like oil and agriculture could also increase. These sectors tend to benefit when the value of the dollar declines. Investing in commodity-based companies can be a way to capitalize on rising prices driven by inflation and the debt crisis. One thing to remember as a value investor is to maintain a long-term perspective. The debt crisis might cause short-term volatility, but value investing is about finding assets that are undervalued and holding them for the long haul. Don't panic if the market dips. This is where the real opportunities lie. If you found this information helpful, don't forget to subscribe and stay tuned for more insights on how to protect your investments in these uncertain times. Chapter 6. The Debt Debate Dilemma: Solutions and the Future of the U.S. Economy. The future of the U.S. economy hinges on how the country addresses its mounting national debt. As the debt continues to grow, there are many potential solutions being debated. Some propose austerity measures, while others suggest tax increases or even restructuring the debt. The problem is complex, and no single solution seems likely to work on its own. One potential solution is to cut government spending. Proponents of this approach argue that reducing the size of the federal government and its spending programs will reduce the need to borrow. This could include cutting defense spending, Social Security, or other entitlement programs. However, these cuts are politically unpopular and could have significant social consequences. Another option is to raise taxes. This would increase government revenue and potentially reduce the deficit. However, raising taxes can be a double-edged sword. While it could reduce the debt in the long term, it could also slow economic growth in the short term. Higher taxes on businesses and individuals could reduce investment and consumer spending, leading to a slowdown in the economy. Some economists suggest that the US should simply grow its way out of the debt crisis. By encouraging economic growth through pro-business policies and technological innovation, the country could increase tax revenue without raising tax rates. This strategy relies on the idea that a growing economy will eventually reduce the debt to GDP ratio, even if the absolute level of debt continues to rise. Debt restructuring is another option being discussed. Some experts argue that the US could restructure its debt, much like a company going through bankruptcy. This could involve renegotiating the terms of the debt or even forgiving some portion of it. However, debt restructuring could damage the US's credit rating and cause a loss of investor confidence, making it difficult for the government to borrow in the future. The most extreme solution, of course, is default. This would involve the US simply refusing to pay back its debt. While this might offer short-term relief, the long-term consequences would be catastrophic. A default would likely lead to a collapse in the value of the dollar, skyrocketing interest rates, and a global financial crisis. It's an option that no one takes lightly. Looking further into the future, some experts believe that the US might shift to a new economic model altogether. The rise of digital currencies, for example, could change the way the government interacts with the economy. Central bank digital currencies, CBDCs, could potentially allow the government to manage debt more effectively, but there are still many questions surrounding their implementation. In the end, the US government will likely have to combine multiple strategies to address the debt crisis. A mix of spending cuts, tax increases, and economic growth initiatives will be needed to stabilize the economy. But the path forward is unclear, and each solution carries its own set of risks and rewards. The future of the US economy depends on how well policymakers can navigate this debt dilemma. The solutions won't be easy, and there's no guarantee they will work. But one thing is certain: the US cannot continue on its current path without facing serious consequences. Whether the country can avoid a debt crisis or not is still up for debate.